Jonny, thanks for joining us today. Why don't you just introduce yourself?
Absolutely. Thanks, man. So fun to be hanging out with you guys again. So I grew up in the UK, started my career in strategy consulting, did that for 6 years. And then you guys saved me, brought me to Kiva back in 2011 to launch the Kiva Zip pilot, which I then...
Kiva Zip, what's that?
Kiva Zip was an innovation that we rolled out in 2011 to basically make the Kiva model more direct. So rather than lending through these microfinance institution intermediaries, which is how the Kiva model had evolved towards in the first few years, Kiva Zip was cutting out the middleman and lending directly to the entrepreneurs, both in Kenya and in the US. And we were lending at 0% interest, whereas MFIs, as you guys know, were usually charging an interest rate. And so it was a direct connection. And the coolest anecdote for me was there was this borrower who I met in the slums of Kibera in Nairobi, and she got a $125 zero interest loan from 5 Kiva lenders. And one of those was this guy in Sweden, Hans, and he sent her a message through the Kiva Zip website, which she got as an SMS, and then she responded by her SMS, and he got that. And that for me was just like the most beautiful illustration of what Kiva was all about. And these loans were in Kenya being dispersed through M-Pesa. In the US, we were lending via PayPal. And
Premal, I forget who thought of Kiva Zip. How did it? What's the early origin story of Kiva Zip? Even before Jonny, we were talking about it, right? Or did Jonny think of it?
I think so. I'm Matt. I think that was the original version of Kiva. I mean, you could argue that Moses Onyango, the pastor that is effectively a co-founder, was trying to basically trying to do direct person-to-person lending, and then Kiva got strong enough through the MFI model that we had space to maybe try it again. It felt like something that we always wanted to do. It just didn't seem clear how you could do it. I mean, how you could do it in a way.
How did we pick that year? How did it actually get set in motion that year? Why was that the time?
I reckon it was partly an emotional response to 2009 David Rubin. Is that?
Oh yeah. So
David
we were getting
Rubin wrote this New York Times article about how Kiva is not as direct as it seems, and the loans are pre-dispersed, and they're going through these intermediaries. And so the vision, brand of Kiva on the website is like true connection is actually not as real as it seems. And so for me, I always thought this. You guys would know better than me. That was like somewhat of a kind of okay, let's try to get back to kind of true causal connection where that body is not getting the loan unless the crowd fund it. There's another, over time, most crowdfunding platforms, as you guys know, have grown where the project owners are like recruiting the backers, right? So on GoFundMe, like the project owner recruits all the donors, and that's how they grow. Like on Wefunder, where I work now, like the startup founders like bring most of the investors, and that's how the Wefunder investor base grows. And on Kiva, there was never that dynamic. And so over time, Kiva US, because the US small business owners were recruiting their networks to lend to them, that came to account. I think by the time I left, it was 50% of new lender acquisition for Kiva. And so I don't know if that was in your guys' mind. That wasn't in my mind in 2011 when we launched it. But over time, for me, that became like, oh wow, this is a very, very powerful kind of for Kiva to be doing this. Was that kind of what you guys were thinking?
Yeah, I think it was like a combination of so many factors. I think the emotional factor was definitely one of them. I remember, we woke up one morning, maybe it's 2008, 2009, where David Rubin wrote a blog entry criticizing Kiva. I think it was called like Kiva's Not Really What It Seems, something. Essentially, arguing that it looks like it's direct, but in fact, it's indirect, how the money gets to the entrepreneur, which is fair. But I just think I was hurt by the second order criticisms from that, which, on the internet, even at that time, people just read the headline and then it explodes into another headline. And pretty soon we're in the New York Times. I think Stephanie Strom wrote an article saying sort of Kiva is not, there's a confusion over where the money goes on Kiva or something, which implies there might be fraud on Kiva, which there was not. And that really hurt. Yeah.
So you guys lived through that, right? And in the early days, Kiva was such a darling, and I mean, it still is, you know, even to this day. But there was, you guys, I think, were really kind of prided yourselves on transparency. So how did you feel? Like, what, or how did you feel? And also, like, how did you make it through that crisis? Or what lessons do you have for founders that deal with negative PR like that?
You got us through. It was you, Jonny.
Just hire me. Crisis. The crisis guy.
Premal, I think Premal was really affected by it. You know, he's a really,
yeah.
I don't know, you cared a lot about that stuff.
I did. Well, I think you said it well, which is the second order implication was one of kind of fraud or dishonesty. And, you know, in the nonprofit space, trust is pretty paramount. I mean, people are trusting you with money. Mm-hmm. And then, you know, I think where I went wrong is there's kind of natural, just kind of like, you know, being defensive. But I kept trying to, like, I kept seeing the current Kiva model, the one that was scaling, that had to work through a microfinance institution, as somehow imperfect or not as good. And I think, and so then, you know, kind of in the era of the internet with disintermediation, I thought, hey, look, if you could go direct, that's going to be way better. I mean, borrowers save money if you can go direct, you know, because it comes directly from the lenders. There's that connection that you talked about, you know, between Sweden and Kenya, you know, on a very personal level. There's just all these like benefits of direct. So I just became pretty obsessed with that. And I think maybe the learning is to, you know, there's probably an appropriate reaction. I probably went a little too far in like my
went too far
disdain.
How did you go too far?
Well, I don't think the world necessarily sees lending through an MFI, you know, to reach people who, you know, I don't think people see it as necessarily negative. I think the negative was just that Kiva wasn't really, you know, clear that there was an MFI in the, and you know, on the early version of the homepage, like, you know, we had a direct set of arrows between lenders and borrowers, which would imply that your money goes directly to the borrower versus, you know, you know, refinancing MFIs or on lending your capital and you're taking the risk. And it's so complicated, you know, it's trying to understand, like, you know, the flows of capital across borders is just massively complicated. But so I don't know. I felt like I guess there was always this kind of like, it was kind of wrestling with something that I thought was imperfect, and I was trying to fix that imperfection versus just like accepting that this is like a good way to
idealism you had.
Yeah, I think, and then, you know, Jonny, as you know, I mean, you led the whole effort of our move to try to do Kiva truly direct peer-to-peer. I think a lot of stuff was good about it, but, you know, also was, you know, the default rates were higher. I
was surprised how
higher.
I was surprised at how we found Jonny. And so you were like a management consultant. You weren't doing work at all related to this field. How did you first hear about working here? Who got in touch with you? Was it Premal? It's always Premal.
So Oliver Wyman, which actually back when it was called Mercer Management Consulting, is where Premal spent his. Premal showed this chart, right, to like fellows and stuff of like his life happiness over time. The y-axis was happiness and the x-axis was time. And he'd always show like the time when he was at Mercer Management Consulting was the nadir. So I saw that chart and I was like, oh, I better. But no, I came to volunteer at Kiva in 2009. And then I met my wife, Ali, who you guys know very well. We are now married and living here in Nashville, Tennessee, with 3 beautiful kids, the third of whom is just a month old, Margot. And so anyway, I met Ali when I was volunteering at Kiva, working with Naomi on the review and translation program and JD on the fellows program. And then I went back to Oliver Wyman in their London office, but me and Ali were dating long distance. And then I got Oliver Wyman to transfer me.
Was it a secret? Was it a secret office romance?
We were like kind of sneaking around for sure for a while, and then eventually it became.
Why?
How did you bridge that gap from volunteering with somebody?
You guys were such dragons, you know, as founders. We were just so living in fear about the.
That might have been pre-HR pre-HR department at Kiva.
Yeah,
Our
it was part
relationship
of probably
Matt,
was what
Matt coined
spurred
this
the
phrase,
creation.
HRD Gras.
Yeah, that was before HR Gras. HR Gras is the last day before getting the HR department at any startup. It's called HR Gras. That's where you do.
That's when you have the party, the wild party, and then the next.
That's
day,
where you find
hangover.
your future wife. You find your future wife. But how did, like, can you remember the first moment where you went from professional to romantic?
Strictly professional to romantic.
What's the first moment?
What was that moment? By that.
We were out for a dinner, like with a few other Kiva people as well, and then we after that dinner, I remember just like chatting about it in like.
Jonny, was it after the softball game?
The softball game was, I think, probably when Ali first noticed me. With the scores tied, the bottom of the ninth,
incredible.
The ball skyrockets up into the air.
Jonny has no glove. Jonny has he's only a guy in the outfield anywhere in the field without cricketers
one-handed to win the game. Actually tied.
And then once he catches this ball, he throws it up in the air, like the cricketers do.
Is it?
And then
it was a very British thing.
But yeah, so Ali was watching, and I think that's the moment, right, when she knew. And then, so then we were living in the same city, San Francisco, and then I decided to leave. We got married, and then I decided to leave Oliver Wyman, and then I didn't know what to do next. And then you guys were thinking about starting Kiva Zip. I was
because you were like the best intern. We had this ranking of all the interns, a power ranking in the back room, and you were number 1. And so we were just gonna go down the list and find through the best interns. And you rose to the top. We called you up.
I would say Jonny is like one of the best interns ever. Like,
well, it's just his trick is all he does. He tricks you because he knows Excel really well.
He knows Excel and PowerPoint.
That
guy killed it.
He knows every power key in Excel. Can you give any
macro? Maybe?
Man, you once said that watching me on Excel was like watching Liberace play the piano.
Yeah, it is. It's like like key sequences that are.
I wish I'd learned Ruby on Rails, but so actually this is an interesting point, because then to go back to your question on why I like ended up at Kiva, starting Kiva Zip. I mean, you guys hired me. I don't think I was the best person for that role, honestly.
Right.
Because
I figured that out. Yeah.
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 I'm interested in your take on this, Premal. For me, like, management consulting is kind of antithetical to like being a startup founder. It's all research, it's all analysis. It's not like executing and doing. And so I like really had to unlearn those lessons. And I honestly think I'm still unlearning those. For me, someone like, or you guys, or like Justin, it was great, bringing Justin on, or Akash, some of these other cast of characters. I think like I was good in the sense of like Kiva Zip being a, quotes, disruptive pilot within a bigger organization, which we should talk about whether that was a good idea, and also whether it was a good idea to start in 2 geographies.
But I remember a time when it started really working and getting exciting. Their payment rate was pretty good. We were scaling, and then all of a sudden, your personality changed a bit. You were dating Ali. You're more confident. You started going to conferences. You sort of took on a life of your own. You sort of got a little bit too big for your britches.
I just got intoxicated by the fame.
Jonny, you were able to work. I mean, you're insanely capable. What was it like to work for Matt and I?
I'm insanely capable. I'm insanely capable at Excel.
Dude, but what's your attitude? What's your attitude towards bosses? Like you're running a program. But you have a couple bosses at least. I don't know.
I think actually one of the things I'm very good at, sounds like unlike you guys, and again, this is probably why I'm kind of less of kind of a founder DNA. But I think I'm very fine to work with, a boss and be kind of deferring to them. I'm also kind of pretty fine to delegate downwards as well. I'm an ENFP. I'm very kind of laid back, I would say, to a fault. And so, even if I have a very difficult manager, then I'll be able to roll with that. Not saying you guys were.
That's how we did it. That's how I made it through.
Yeah, I mean, it was a hard 7 years. And, there's a lot of hard things now working at Wefunder as well. Consulting was hard as well. The 3 things I've done are hard, but there were a lot of challenges from the 7 years at Kiva. It was a grind.
What were they?
Okay, yeah. What were the hardest parts?
What was the hard thing about hard things for Kiva Zip?
I mean, every startup is hard, right? There's all the kind of normal challenges. The one that jumps out to me though, I'd be interested in you guys' take on this, is like starting this as a part of a bigger nonprofit that was by that point 6 years old and kind of pointing in one direction. And I think you would agree with this, like the culture of Kiva maybe wasn't as kind of embracing of kind of entrepreneurship. I think nonprofits generally versus for-profits like tend to be more kind of conservative maybe, or like everyone is so into the mission that the people in a really good way, but there's a downside of that as well, that they're kind of emotional and kind of, apprehensive about change. We would hear like do no harm, which is like, I think a kind of a crazy concept for like a startup fintech. So doing Kiva Zip as part of a bigger nonprofit and trying to win over the lawyer and the CFO and the partnerships team and the HR guy, like, rather than just having complete autonomy as you did when you started Branch, that was an additional challenge on top of.
Could I just clarify something for the listeners, which is the do no harm, impossible for fintech. What I think just to get into it, in the microfinance world, there's this idea of responsible lending, and because you make loans and the average loan has an interest rate of 35%, if you give money to people who can't service that debt, can't turn that into good ROI, they can get into a debt spiral, and that could have consequences for them. And so this idea of you don't want to over indebt people. And so you don't want to do harm. And I think kind of what was confusing to all of us here, Jonny, was that we're doing this 0 interest loan program from a bunch of people who are wishing you well. And so if you can't pay back your loan, first of all, you're not accruing some kind of there's not like some meter that's running around like your interest, your interest rates are going up and ballooning and you're going to, be put out of your home at all. And then second, it's quite forgivable because as long as you, just say, hey, look, my business didn't work out for X, Y, Z reasons.
We didn't seize anyone's.
There's no collection mechanism. It was really based on a spirit of generosity. And so we were kind of getting the critiques that kind of microfinance had within itself on a new model that was very different than kind of, microfinance.
But even if we did kind of negatively impact the borrower's life, right? Like,
which is hard to imagine how you would with a 0 interest loan that is forgivable.
Well, we started reporting.
What?
We started reporting on borrower's credit, right? So in the US, we started reporting on borrower's credit, and so we would negatively impact their credit score, which would damage them. Or maybe you say if you default on the loan, then you even just you feel bad that you let down these lenders, right? So, but for me, you. Obviously, if you're doing lending, there's going to be defaults.
Really quick, I want to ask Jonny, what are the 1 or 2 best moments in your Kiva history? Single moments, most climactic, other than meeting your wife. What were your favorite moments?
That's obviously number one. We launched Kiva City in Little Rock, Arkansas in 2013, and Bill Clinton, who has since become a little more of a controversial figure, but whatever, that was just amazing. He stood up, and this was only 2 years in. We grew a lot more after that. This was pretty early, and he stood up and just talked about how this Kiva Zip model. He said one thing I'm really excited about is the new Kiva Zip model. And that was just incredibly inspiring. And then he also launched the Kiva New York program a couple of years later.
Just a little context here. So you work for Wefunder now, which is a equity crowdfunding platform for people in the US and small businesses to raise, equity dollars, investment dollars from the public. Has that been as rewarding from a social mission standpoint for you as working at a nonprofit?
Yeah, I think so, in a different way. I mean, I love nonprofits. I think there's a lot of structural problems with nonprofits, but I actually think they're very, very important. I might end up back there one day. But from a depth of impact perspective, in terms of like, reaching low income people and really, really helping them. I think obviously, Kiva had a much bigger depth of impact as a nonprofit, but with Wefunder, there's just so much more scale, right? So this month we'll do about $10 million of investment volume. When 7 years in to Kiva US, wow. we did I think $7 million the last year I was there. And so as with a for-profit model, a sustainable business model, when you're offering a return to investors, there's just so much more potential to scale. So you're trading off some depth of impact for breadth of impact. But I would say both are awesome.
I've seen a lot of these equity crowdfunding platforms come and go. A lot of them were excited after the passage of legislation enabling this under the Obama administration. And then it seems like it was a dud. The whole industry was sort of a dud for 5-10 years.
Yeah, so the Jobs Act passed in 2012. It took the SEC 4 years to roll out regulation crowdfunding, which they did in May 2016. So it's been live now for 4.5 years. And in the early days, there were some challenges in the regulations. We're growing pretty quickly now. We did $1.5 million last October, and we'll do 10 million this October. And that's going to accelerate. The SEC are increasing the cap from 1.07 million to 5 million. That's going to massively accelerate the growth of the sector. So
cap of what? What's that cap?
Every year, as a startup, you can raise 1.07 million through this regulation crowdfunding exemption, where you can raise from unaccredited investors as well as accredited investors and publicly promote the offering. So 1.07 million per year has been the cap, and maybe soon the SEC, we think they will increase the cap to 5 million. So now a startup that could easily raise 5 million, but they're kind of cutting off at million, might not be able to raise 5, or many other startups that don't want to do it if the most they can raise is $1 million will now start to come to Wefunder and raise. And so even without that, we've seen a lot of growth through COVID as well. I think startup founders finding it harder to raise capital, turning to Wefunder as an alternative option. So we're already seeing underlying growth. This cap lift is going to just pour fuel on the fire. And so I think it's going to become a bigger and bigger share of angel investing over the coming years. It makes total sense, right? If you're a startup founder right now, you're raising an angel round, you can only pitch rich people, top 5% of the population, to accredited investors, and you have to do it privately. That is so inefficient. And by the way, it leads to very inequitable outcomes where 1% of VC goes to black founders, less than 3% goes to female-only founder teams. So it's just a more efficient system, right? To say, well, you can promote it to anyone. The accredited investors can still invest, but now unaccredited investors can invest too. You can publicly promote it. You get in front of 700,000 Wefunder investors. It's hard to argue that is not a more efficient, just better system. And so I think it's just going to become more and more popular.
How did the returns work? So you talked about the 700,000 kind of Wefunder existing investors, and then earlier you talked about kind of most of the fundraising that goes to a small business or a venture on the platform is really from that ventures network, right? So you're kind of hitting up your friends and family to invest in your business, and you're using the Wefunder platform to kind of facilitate that. Can you kind of put numbers to that? Like how much of it is really kind of the ventures own community versus like random people coming to the Wefunder website, looking through projects and making investments?
So the average company raises 350 grand on Wefunder, and about 2/3 of that comes from new investors, first-time investors on the platform, and 1/3 comes from repeat investors making a second, third, fourth investment, i.e., people we bring. And then of the new people, some of them are friends and family, customers. Some of them are investors, right? So it's like if you're trying to pitch investors on investing in your startup, you should still do that and close those 25, 50K checks. But now you can also run a marketing campaign. you can also get in the press, you know, get the word out. Like if you guys put branch up on Wefunder, you know, you could raise $1 million, like, you know, in a heartbeat. Let's talk. Just kidding.
How does
you're a little
what's the motivation?
So I thought
what's the motivation for the
money,
1/3
for the investors?
And how does that return profile look like historically, kind of the IRR of being an investor on Wefunder, looking at kind of different things to invest in? Like, how does that work out usually?
Yeah, so the return profile, or the motivation is, I mean, obviously people are investing in startups to make money, right? But I think for a lot of angel investors, the motivation is also because they want to like be involved with this cool company, or sometimes like they really think the founder's awesome. We talk about invest in startups you love. So the brand that we're trying to cultivate on Wefunder is not like invest in startups to make a ton of money, but like invest in startups because, you know, you care about this company or you think this is really cool and it's cool to be an angel investor. And maybe if you're investing in this brewery, you know, we do Main Street businesses as well as tech startups. If you're investing in this brewery, you walk in, the owner gives you a high five and a free beer, you know, like.
Does that really happen?
For sure. Yeah.
The dream of getting a free beer at a local brewery because you invested in one share equity. Is that a real?
Yeah.
I've heard about that fantasy for a long time. Is it really?
Yeah, that's like the perk that, you know, a lot of founders will offer. And it works the other way as well, right? I wrote this blog post, which this one consumer facing startup they sold online direct to the consumer. And so they had rich sales data. So I built an Excel model that basically mapped their transaction data to the Wefunder investor data. And I found that people that were not previously their customers that invested in the startup then went on to become customers and spend money with them. And then existing customers that invested in them went on to have a higher LTV and a lower churn than customers that didn't invest. So that's the second value prop to the founders. Yeah. The first is like, we're making it easier for you to raise money. And for a founder, like my pitch, and obviously founders can take it or leave it, but my pitch is if you have 1,000 early investors, then that's going to be loyal customers, brand ambassadors, champions. To go back to your question, Premal, on the IRR, I mean, we don't really have great data, to be honest. It's also pretty early. Like, you know, the law changed in 2016. So we were a lot smaller back then. So it's pretty early. I will say, like, the caliber and the quality of the startups has been significantly increasing more recently. Like, until earlier this year, we couldn't roll up the individual investors to one line on the cap table, which is often a deal breaker. But that being said, like in the Regulation D days on Wefunder, we got into four unicorns, Zenefits, Checker, Ginkgo Bioworks, and Rappi. So at least on paper, I think our portfolio IRR is pretty good. But the realized IRR is it's still, I mean, it's all on paper. Right?
And is it just equity, or is it is there a revenue agreements? What's that? You can do debt.
We do a few loans as well. I'd say probably right now like 90% is equity, and either convertible notes or safes or price rounds, but some debt as well. We do some revenue share based debt where borrowers are paying back as a percentage of their revenues, but mostly vast majority is equity.
Jonny, one last thing I want to talk about was politics. I was amazed in the 2020 presidential election how early on, like literally the first month, Andrew Yang started running for president. You were like full bore behind him, part of the Yang gang, one of the founding members of the Yang gang, sort of like a religious believer in UBI, ranked choice voting, and all the policies that Andrew Yang was pioneering and getting out into the public. Why did you latch on to that so early?
Yeah, well, I connected with Andrew when he was running Venture for America, and I was running Kiva US, and we met at this event at the Kauffman Foundation when Kauffman Foundation were like, how do we invest $1 trillion in US entrepreneurship? And my pitch was basically give Kiva US, 0.1% of that. $1 billion is fine. So I met Andrew there, and I just thought he was a really, really awesome guy. And then we were talking about a partnership between Venture for America and Kiva. And then the next time I saw him, I was like, how's Venture for America going? And he told me on a bus, I remember he told me, I'm actually going to leave and run for president. And I was like,
You're like, president of what?
Of the United States. And so, but I just think he's like a really awesome leader. I think if I looked at everyone on the debate stage, I thought his ideas were just brilliant, and his character is noble, and he's just forward thinking and thinks about things with a fresh lens, and he's got a good heart. And so I wouldn't say I'm a religious, kind of believer in
zealot.
I don't know if I'm even a big UBI fan. I think it's a good idea. It's at least worth exploring. But a lot of his other policies and just his general, I just think he's an awesome guy. He'd be an amazing president. So yeah, I donated a little bit to him early on, and was just kind of championing him. And actually, my colleague at Wefunder, Dylan Emright, went to be his finance director on the campaign pretty early on. But I'm very interested to keep following along with him. I'm curious to see what he does next. After Matt and Premal Fintech talks, the Andrew Yang podcast, Yang Speaks, is probably my second favorite podcast.
That's a good one. Yeah.
I gotta go, guys.
I gotta go too.
Peace. All right.